Welcome to The Explainer. Today, we're doing something really exciting. We are stepping into the shoes of expert investment analysts to put a massive $77 billion refining giant, Valero Energy, ticker symbol VLO, through the absolute ultimate valuation gauntlet. We're not just glancing at a single metric here. Oh no, we're stacking up the legendary investment philosophies of Warren Buffett, Peter Lynch, and Benjamin Graham, and then stress testing them all against hard mathematical models.
So, with the stock currently trading at around $260.62 a share, our big question today is this. Is Valero Energy a dangerous value trap teetering at the very top of an industry cycle, or is it a hidden gem just waiting for the broader market to wake up and uncover it? Stick with me because by the end of this analysis, we are going to have a definitive answer.
Here is our roadmap for the breakdown. First, a quick Valero snapshot. Then we'll view it through the Warren Buffett lens, the Peter Lynch lens, and the Benjamin Graham lens. After that, we'll run a DCF and some alternative models before wrapping it all up with our synthesis and final verdict. Let's jump right in.
All right, part one, the Valero Company snapshot. Let's make sure we really understand the business.
You know, a lot of people just think traditional oil when they hear the name Valero, but they are far more than just a legacy petroleum company. Yes, absolutely, they're operating at near-peak efficiency across 14 traditional refineries with a mind-boggling throughput capacity of 3 million barrels every single day. But here's the kicker. They are also rapidly scaling low-carbon fuels. Through their Diamond Green Diesel joint venture, they're turning out a staggering 1.2 billion gallons of renewable diesel and sustainable aviation fuel annually. Add to that 12 ethanol plants pumping out another 1.7 billion gallons a year, and you've got a massively diversified energy portfolio driving that $77.39 billion market cap.
And this trend right here is exactly why analysts and the broader market are paying extremely close attention right now. Valero's earnings per share took a slight dip from $8.58 in 2024 down to $7.57 in 2025. Pretty standard cyclical stuff, right? But wait. Analysts over at Erste Group are projecting a massive, jaw-dropping EPS spike up to $28.12 for 2026. This incredible leap is being driven by expectations of significantly stronger refining margins and expanded production capacity.
So, with those exciting numbers in mind, let's move to part two. The Warren Buffett lens, where we hunt for economic moats and owner earnings.
Evaluating Valero against the Oracle of Omaha's core principles actually yields some really strong results. Economic moat? Definite pass. Their massive physical scale and the huge regulatory barriers to building new refineries make their existing assets incredibly valuable. Consistent earnings? Pass. Sure, refining is famously cyclical, but Valero stays highly profitable through the bumps. They also easily pass this test for high return on equity, clocking in at an excellent 15.94%. Debt? Super manageable with a remarkably low 0.39 debt-to-equity ratio. And finally, honest, shareholder-friendly management? Well, the recent proxy shows they just returned $4 billion in cash to stockholders and consistently raised their dividend. So, pass.
Now, Buffett's ultimate metric is owner earnings, basically the actual cash a business generates for its owners after maintaining its physical assets. If we take Valero's 2025 operating cash flow of $5.82 billion and subtract their $1.88 billion in capital expenditures, we calculate an approximate owner earnings figure of $3.94 billion. That is a massive baseline of cash generation to support its intrinsic value. Strictly from a Buffett perspective, Valero is looking like a highly robust cash-printing operation. Okay, let's switch gears to part three, the Peter Lynch lens, where we're looking for growth at a reasonable price.
Peter Lynch famously categorized stocks into stories to figure out how to trade them. For Valero, he would almost certainly categorize it as a cyclical stalwart. What does that mean? It means understanding that earnings are naturally going to ebb and flow with commodity prices, so timing the cycle is key. However, and this is a big however, because Valero operates with a stalwart's rock-solid balance sheet, including an excellent current ratio of 1.58, it offers tremendous downside protection when the economic cycle eventually turns against them.
But the absolute crucial point for Lynch would be this astonishingly low PEG ratio of 0.38. Quick refresher, the PEG ratio divides the price-to-earnings ratio by the projected growth rate, and anything under 1.0 is considered undervalued in Lynch's playbook. Because analysts are projecting that massive 170% earnings growth up to over $28 a share, Valero's 0.38 PEG indicates this stock is highly undervalued relative to its explosive projected growth. So you can see a really fascinating tension building between our analytical frameworks here. Peter Lynch loves that growth story.
and would probably smash the buy button based on the PEG ratio and strong insider alignment alone. But Benjamin Graham, the legendary father of value investing, he doesn't care one bit about projected growth. Graham acts as our unforgiving accountant. He's looking strictly at the hard assets right here in the present moment.
Which brings us perfectly to Part 4, the Benjamin Graham lens, focusing purely on strict defensive valuation.
Looking at Graham's defensive checklist, Valero passes the initial test with flying colors. It has adequate size, a totally stable earnings history, a reliable dividend paying out $1.20 quarterly, and a really strong financial condition. But Graham is notoriously strict on valuation multiples. He wants a price-to-earnings ratio under 15, and based on its trailing 2025 numbers, Valero is currently sitting higher at 1894. He also demands a price-to-book ratio under 1.5, but at $260 a share against a book value of $77.78, Valero's P/B is roughly 3.3, so it firmly fails Graham's core valuation tests.
To find out exactly what Graham would actually pay, we have to apply his famous intrinsic value formula, which strictly anchors the stock price to physical asset value and recent trailing earnings. Let's plug in Valero's 2025 EPS of $7.57 and its book value per share of $77.78.
When you run the math, it resolves to a hard $115.10. That's a huge difference. This means a strict Graham defensive investor literally wouldn't touch this stock today. They would demand a massive margin of safety, waiting for a drop from its current $260 price tag all the way down to around $115 before considering it a safe, asset-backed buy. It's a stark reminder from Graham. If a cycle turns and those huge future earnings projections don't materialize, there's a very long way to fall to reach pure book value.
All right, let's step away from the specific gurus for a moment. Part 5. DCF and alternative models, where we let projected cash flows do the talking.
Because we don't have exact multi-year free cash flow projections explicitly handed to us in the core data, as expert analysts, we have to make some logical industry assumptions. Let's start with our previously calculated owner earnings of $3.94 billion as our base free cash flow. Given that massive EPS growth projected for 2026, we'll model a relatively conservative 5% cash flow growth rate over the next 5 years. We'll then discount that back to the present using an 8% weighted average cost of capital, which is a standard rate for established energy firms, and we'll assume a 2% perpetual terminal growth rate.
If you run those baseline assumptions, it yields a fair equity value of roughly $235 per share. But as we know, DCF models are incredibly sensitive to the inputs. This sensitivity matrix shows how changing our discount and growth rates flexes that valuation. For instance, if growth is a bit stronger and our cost of capital is 7%, suddenly the stock looks like a deal at $285. But if the cycle weakens and bumps our discount rate to 9%, fair value drops all the way down to $198. All in all, the base DCF suggests Valero is hovering right around its fair value.
To give us a full picture, applying two alternative models gives us the edges of our valuation band. First, a conservative dividend discount model, which values the company purely on the present value of its future dividend payouts, prices Valero at just $120. Notice how close that is to Graham's defensive number? On the flip side, if we look at an EV/EBITDA comparable model, assuming a standard 6x industry multiple on their projected surging earnings, the fair value jumps way up to $280.
We've put it through the ringer. Let's get to Part 6, synthesis and final verdict.
This final matrix right here is the ultimate takeaway from our explainer. With the stock sitting at $260.62, Peter Lynch is practically screaming strong buy thanks to that 0.38 PEG ratio and massive earnings growth. Benjamin Graham, on the other hand, says avoid because you're paying a huge premium over the historical book value. Meanwhile, Buffett and our core DCF model are sitting right in the middle, targeting around $235. So blending all these expert insights, our final verdict is that Valero at $260 is a solid hold. If it dips down toward that $230 range, it really becomes a compelling value play. Its biggest strength is undoubtedly its robust cash flow and dividend, but the big risk is the cyclical nature of refining margins dropping off faster than anyone expects.
I want to leave you with one final provocative thought to chew on. Ultimately, the true wildcard for Valero's future valuation boils down to this. Will their massive 1.2 billion gallon renewable fuels capacity finally decouple them from the historical boom and bust volatility of traditional oil cycles? Because if the answer is yes, then Peter Lynch's crazy growth projections might just be the tip of the iceberg, and this cyclical stalwart could completely transform into a secular growth engine. Think about how that changes the math. Thanks for exploring the numbers with us today, and we'll catch you next time.